But eventually, what I've been saying is that this problem gets so bad that people will start looking for a new global reserve currency. And I believe that Bitcoin is the front runner in that game because it's just a better version of gold.
Hi everyone, welcome back to the Stefan Livera podcast, brought to you by Swan.com. Today, we're going to be talking about the Japanese market and a range of things that all relate to the world of macro. And so joining me today is Peruvian Bull. I found some of his commentary really interesting, so welcome to the show, Peruvian Bull.
Thanks for having me on. I've been a huge fan of your podcast, listened to quite a few episodes, and so I'm excited to now be making one.
Oh, cool. Well, hey, I had no idea. Well, thank you. So look, I know you're pseudonymous, let's say. So just give us a bit of the background, whatever you're comfortable sharing in terms of what's your focus? What are you mainly talking and commentating on?
Sure, yeah. So I used to work in traditional finance at a private equity fintech for quite a few years. And after working there and had some fund management, last summer I just had to quit my job and go into macro writing full time because I'd been doing that on the side for a while. And I came across Bitcoin in 2021 with the GameStop fiasco. And it really started opening doors for me and changing my whole mindset around finance and macroeconomics. And previously I'd been a gold bug and been really hard stuck in the gold bug camp. And the Bitcoiners completely broke that model for me, and so I had to sell most of my gold and ape into Bitcoin.
Nice.
But so I've been writing since August. I've been writing full time on macro. I've also written quite a few pieces on Bitcoin itself, on how it solves Triffin's dilemma, on the Lightning Network, on scaling solutions, and so we can get into that because that's also a really interesting rabbit hole. Bitcoin becoming a global reserve currency, but I currently I'm just covering macro, and I've written quite a few pieces recently on the Bank of Japan and their predicament with holding their currency at the 160 mark.
Yeah, so let's get into some of this. This has been an infamous thing for decades now, and I guess let's try to set the table for people. Like, I don't consider myself like a macro expert or anything like that, but I find it sometimes entertaining to sort of hear some of the different perspectives. So can you just, let's say, set the table for us, set the context for us here, like what's going on with the Japanese yen and the Japanese government bond market?
Sure, yeah. So actually, I think Japan is an appropriate, kind of like bellwether for the entire, global central banking apparatus. They've gone farther and faster than any other central bank in experimenting in monetary policy. So they were the first ones to start QE in March of 2001. They were the first ones to do yield curve control in 2016. And what they were trying to do was they had essentially created a massive credit bubble in the 1980s. And when it popped, their real estate and financial sectors declined precipitously. They had essentially like a slow rolling deflationary crisis, and they tried everything they could to get themselves out of it. And typically, as central banks do, right? Like, they cause the problem and then they blame other people and other things for causing the issue. And they first blame it on demographics, which was part of the problem, but definitely not the main source of it. And so, they started that QE program in 2001. And then with the 2008 financial crisis, they upped their bond purchases. And then in 2016, they said, look, like, we're not seeing any growth. Like, the stock market is still down from its high in 1990, and we can't figure out any other way to stimulate the economy other than the wealth effect. So let's just go full bore on bringing interest rates to the zero bound, or even negative in some cases on the short end, and pin them there. And so that's what they did in 2016. And they spent trillions and trillions and trillions of yen doing that every single month. And what they essentially began doing is what I call eating the bond market. So the Bank of Japan slowly began buying all the outstanding bonds. And first they started with the less traded maturities, the illiquid issues that the banks just wanted to get off their balance sheet. But soon they moved into the 5-year and the 10-year and the most, what are called on the run issues, the ones that are most traded. And they got to the point where now they own over half of the entire outstanding Japanese bond market, and they own, technically, their balance sheet is larger than the entire GDP of Japan. And so they've essentially like monetized the entire financial sector. And so what that's done is when they've brought interest rates down to zero for so long, they've created what I call financial gravity. It's this horrible feedback loop where you bring rates lower, more debt is accumulated because it costs nothing to borrow and it costs nothing to lend. And so banks are incentivized. It's like, hey, there's no risk. Like the government will buy your bonds or buy any debt that goes bad anyways. So just lend. And consumers have no disincentive to borrow, because why wouldn't you? If you can borrow at zero, or if your company can borrow at zero and pay nothing to roll the debt, you'll borrow as much as you can. And no one went farther in the borrowing scheme than the government itself, to the point where today we're sitting at 266% debt to GDP. And so the government is now in this what I call a monetary black hole. They're really stuck, because if they try to normalize interest rates, if the Bank of Japan tries to normalize interest rates with the rest of the world, like let's say the Fed, for example, the government would eventually be paying 13% of the Japanese GDP in interest alone on the debt. So they've essentially trapped the government, right? The Bank of Japan, with their lowering of interest rates and allowing the government to just go deeper and deeper into debt and monetizing that debt via QE, via yield curve control, which is basically QE infinity by holding the cap. They've allowed the government to go deep into this black hole, and there's essentially no way out. And what I've been writing about is, what is the ultimate, end game for this? What happens? And the issue is, once you get to a point where this debt is so high and you're running QE and inflation starts to return like it is in Japan right now, and your currency starts weakening because of a carry trade that's opening up because of the interest rate differentials, there's nothing you can do to save the currency, right? Like the traditional response in macro is to raise interest rates, because if the US has interest rates at 5 and you have interest rates at 5, well, then there won't be any capital flows other than trade between the countries. But if there's a huge difference in interest rates, then people can borrow in yen and buy USD assets or lend in USD and earn the spread. And so that's what's been happening, because the Bank of Japan pinned interest rates so low for so long. $4 or $5 trillion of a carry trade opened up. And so all these people are borrowing yen and buying USDs, which is drawing money into the US markets and is drawing money out of Japan, and essentially it's a synthetic short on the yen. So every time people borrow yen, it's creating more yen, they're selling it on the market, and that's shorting the yen, and the yen just keeps weakening and weakening and weakening. And in the past 4 years, it's gone down by about 50%. And so the Bank of Japan has been trying to do things to stop this slow motion train crash. And they first started with, in December 2022, they moved the cap on their yield curve control. So they had it pinned at the zero bound, and they finally let it go to 0.5%. Such an amazingly high interest rate, right? And when they did that, there was a huge volatility in the bond market. The Japanese Securities Clearing Corporation issued a margin call. A bunch of firms had to liquidate, other collateral treasury securities to try to figure out how to deal with their levered Japanese bonds, because they were all levered long. And now suddenly the government's saying, okay, there's no longer a floor on the price. We're going to let the interest rate rise to 0.5%. So they did that. And then about 6 months later, in last July, they moved the cap again to 1%. And then they started doing random bond buying operations to try to scare the bond market. And the end result of this is that they're trying to, sit on two sides of the fence at the same time. Their monetary policy makes zero sense, right? Because on one hand, they're printing yen to buy these bonds to keep the bond market, from imploding, because essentially, no one really has any demand for bonds at 0%, even the Japanese. They don't have enough. And on the other hand, when you print that yen and plug it into the financial system, it starts blowing out the currency, because all this extra yen is being created, and now all these people can short yen or can sell yen and use that to buy USDs and earn interest rate. And so what the Bank of Japan has been doing is they've been printing yen with one hand, and then they've been selling dollar assets and buying yen with the other to try to defend the cap. And this last week, they did two interventions. They did one on Friday as the yen hit 160, right after Ueda's Bank of Japan meeting. And then they did another just on Wednesday night, trying to bring it down to 153. And so they've been able to bring it down, but it's cost them about, $50 or $60 billion. And again, this is what I think is this is indicative of the trap that all central banks are facing. It's just that Japan is ahead of the curve. They're the first ones hitting this because they've gone the farthest in this debt black hole.
Fascinating. And I think this is something people have been commenting on, many of these trends and practices for decades. Literally for decades, people have been talking about the carry trade. People have been talking about, let's say, the Japanification of the rest of the world. And so in, let's say, macro circles, they've been talking about this is kind of like, look at what's happening in Japan. That's going to be sort of, you're looking at the future for other countries in some ways. And so it's kind of, it's sad, but it's also instructive in certain ways of what is going to happen to the rest of the world as this happens, right? And they are unique in certain ways, right? As you said, their government debt to GDP, 260% or in that range, which is just like off the charts level compared to every other country. And people have always offered different answers on why it is they can do that, right? They say, oh, they're culturally monogamous, or culturally, what's the word? Like similar. And homogenous, and therefore, there's more quote unquote willingness of the Japanese people to sacrifice, so to speak, right? Like this idea that they're okay to just let their currency keep devaluing over time, to sort of have this very stagnating zombie company economy, which sort of paradoxically still makes technology and cars and things, but at the same time, there's clearly been a social and cultural impact in the Japanese society. Like their fertility rate is very low. You're hearing about all these people who have, crisis in various mental health aspects of it, or people just feel like their lives aren't worth living. Maybe part of that is financial, right? Is they're getting crushed so much. But I mean, let's bring it back to what you were saying. So we've got this concept of they're trying to sort of hold the pieces together. Right. And, people talk about this idea of the impossible Trinity. I know that's something you've mentioned as well. So could you just, for listeners who aren't as familiar, can you explain the impossible Trinity and then how these pieces fit in here?
Yeah, sure. So, basically every currency on the macro side is subject to the policy trilemma, or, they call it impossible Trinity or the currency trilemma. And what it involves is a triangle, just kind of like the blockchain trilemma with three sides, three corners. And you can only pick one side, meaning two corners. And so the corners are monetary autonomy, which means your central bank can raise and lower interest rates at will. You can ease and tighten at will. You do what you want. You don't really care what happens to the rest of the world. The next corner is a pegged exchange rate or a fixed exchange rate, which means you can keep that, keep your rate fixed to mainly the US dollar or some other large fiat currency. And then the third is an open capital account, which means your economy is open to flows of money in and out. And you can only pick two. And so, China has also dealt with this as well, right? Like if you have a pegged exchange rate and you have independent monetary autonomy, which means you can do what you want in your country, that means you have to close your borders to capital flows. Because if you're doing something that is not in line with what the rest of the world is doing, then money would logically leave your country. And so you have to stop that by closing your capital account. And if you want to have a pegged exchange rate and an open capital account, which means you're basically letting money flow in and out, but you're still trying to keep that, that rate pegged to the dollar, then that means you have to give up monetary autonomy, which basically means you're going to be a vassal of the Fed. So whatever the Fed does, you copy. If they ease, you ease. It doesn't matter if your economy is already overheating and inflation's already picking up. You have to follow suit with them in order that international capital flows don't start disrupting your exchange rate, right? You want to keep everything even. So Japan is at a weird juncture, right? Because what they're trying to do is they're trying to stand on all three legs of this at the same time. They want to have their independent monetary autonomy. And actually, they have to have that. That's a required corner because, like we said, at 263% debt to GDP, they're past the event horizon of the monetary black hole. There's no normalization possible with the Fed. And so they have to keep rates low. And maybe they can, they've been able to raise them to 1% on the 10-year. And they've gotten rid of negative interest rates. And famously, they raised their basically their equivalent of the federal funds rate to 0.1%, tenth of 1%, which is tiny. It's nothing. But that was big news in Japan. So they need to maintain monetary autonomy. And then they also need to maintain the open capital account because they're an export nation and they're a large international creditor, and so they need to be able to access international capital flows to buy and sell goods and to invest. And so they can't close all their banks to the rest of the world. And so that means that they have to give up that pegged exchange rate. That's the corner that they lose. And they've been trying to hold that line by selling their U.S. assets, their U.S. treasuries. And they sold, what was it, 80 billion between September and October of 2022, held the line there. And then Powell and Yellen kind of came in and helped them by starting to add liquidity to the system, not by the traditional measures, but using reverse repo and the TGA and some other ways of adding liquidity, the BTFP later in March of 2023. But they've been able to kick the can, right? But now this month it's catching up with them again, and so they're faced with this problem of what do, right? Do they sell their U.S. assets and basically fire sell $1 trillion plus of U.S. treasuries, which would drive yields up in the U.S. and make things worse for us, trying to save their currency, or do they just let it blow out? And so far they've been trying to just nuke any shorts. They've been doing a quick attack, nuking the price down, waiting a couple days, it comes back up, they nuke it again from 155 to 153, waste $20 billion doing that, and they can do that, but they only have so many bullets left. Right. And so once they run out of bullets,
yeah. Yeah. So as you're saying, in order for them, as you're saying, there's this impossible trilemma, right? And in order for them to try to keep the currency in a certain range, it necessitates that the Japanese central bank has a certain level of foreign currency reserves or U.S. Treasury bonds, reserves. And it has to engage in the market and actually sell some of those and try to take some action. But as you're saying, with the comment about how many bullets they've got, they can only do that for so long. And so I guess that's the point where you're getting at, which is that they may not have that many rounds left in the chamber.
Mm-hmm. Yeah, and look, if they I had a really good Twitter Spaces on this just 2 days ago, and we were talking about it with Weston Nakamura, who runs a great macro newsletter specifically on the Japanese, and he was saying, look at current numbers, especially if they can't touch their treasury holdings, which is likely because Yellen is probably on the phone with them, telling them, hey, you're a U.S. ally, we have military bases in your country. You cannot fire sell $1 trillion of treasuries, and whatever they have another $7 or $8 trillion of other U.S. assets. You can't sell that to get dollars. We're not going to let you do that because that would cause immediate financial chaos at home. And so if they can't sell their treasuries, they only have so much other foreign currency reserves, mainly dollars, and that means they only have 5 or 6 bullets left, depending on how big the interventions are. And and this is, like I said, they're a bellwether for every other central bank. This is where every central bank is getting to eventually, where they have their currency blowing out, their rampant inflation. They can't raise rates to fight it. They can't do anything other than QE to try to save their bond market. And so they're just trapped in an endless money printing doom loop.
Yeah, that's really sad to see. And I think, as we were saying, Japan is in a very unique position because their government debt to GDP is so much higher than everybody else's. You could maybe argue that some other countries could maybe tolerate some higher interest rates, but just not Japan, because even a small interest rate rise is going to dramatically make things really difficult on the Japanese government being able to fund services, right? That whether it's hospitals and education and roads and whatever, social services. So I guess the interesting question is also if you could sort of spell out a little bit of that interaction between the US market and the Japanese market, right? As you were saying, it's like if they sold too much of their US government bonds, that would have an impact back on the US. So I guess one thing in kind of the world of quote-unquote macro is that sometimes people can maybe overvalue or undervalue a particular factor, right? Like they might say, well, this is the really important thing, but actually that wasn't the most important thing. I'm curious, why is this an important factor, like globally speaking?
Oh, I mean, this is a huge thing, right? Like Japan is one of the large. They're a G7 country. They're one of the largest countries in the world. They're the largest net creditor to the world. They own 1.1 trillion of U.S. Treasuries. They own, another $6 trillion of U.S. assets. And Japan is, like we said, the canary in the coal mine. It kind of all goes back to, again, not to get too esoteric in the history, but it goes back to Triffin's dilemma. And the problem that emerges when you try to have a single currency, a centrally issued fiat currency, that is the global reserve currency, which is what the U.S. has had for the last 60, 70 years, right? What Triffin noted in an address to Congress in 1960 was that, look, like, the entire world needs dollars, and we can either fund those dollars, which means growing U.S. current account deficits. We're basically sending out more dollars to the world on net than we receive. Or we can choose to not fund that deficit, which means the rest of the world, global trade starts to slow because there's not enough liquidity and there's not enough money to settle dollar debts abroad. And so there's basically would be a currency crisis, and people would start redeeming their dollars for gold, and cause the whole system to die. And so he predicted in 1960 that the Bretton Woods system would collapse. And of course he was right. And we just switched from, having gold be the underpinning of the U.S. financial system to the U.S. Treasury. And so now, instead of exporting, gold, essentially, right, we're exporting dollars, then having people redeem them for gold. What we began doing in the 70s was having us export dollars and having people recycle those dollars back into U.S. Treasuries. And that's been playing on for decades. And it's gone to the point now where the rest of the world owns over $7 trillion in U.S. Treasuries. And they own something like $52 trillion of U.S. assets. So that's equities, mortgage-backed securities, houses, real estate, housing, commercial, other forms of commercial debt, ETFs. And so basically the rest of the world has a bunch of U.S. asset holdings. And if they need dollars more than anything, they have to sell those holdings, which can cause a massive recession, obviously deflationary crash in the U.S. Now, I'm not saying it's going to happen. I'm just saying that that's a risk.
Yeah,
and
I see.
The U.S., of course, Japan being, the bellwether of this, the Japan being the front runner, the U.S. has to make sure that Japan does not sell their U.S. treasuries, does not sell their U.S. assets in order to get dollars. And so the U.S. is kind of faced with the problem: is do we let Japan just, Tokyo drift into a currency crisis and just have their inflation blow out and have basically an economic crisis? Or should we, open up a swap line and just print dollars and send them money? And if we do that, that's going to eventually be inflationary for the U.S. because we're just creating more dollars to pump into the system. And so what my work is trying to do is say, like, hey, look, like, Japan is the canary in the coal mine. And if Japan's having this crisis, right, eventually China can have a similar crisis, and eventually, Indonesia. And if they all need dollars more than anything, and if the Fed's not going to let them sell U.S. assets, that means more money printing. And that means more QE, and that means, of course, Bitcoin goes higher. I mean, this is just the next stage in what I call the dollar endgame, in the slow death of the fiat monetary system.
Yeah, fascinating. And what would you make of this idea, or how would you explain this idea? A lot of people are talking about the multipolarity of the world, right? They're trying to say, yes, the US dollar is still the reserve currency for now, but it's waning, right? I can't remember the exact stat, but people were saying it's something like, in terms of the percentage of US Treasury reserves, it's gone over the course of like 20 years or so, it's gone from like 72% down to like 58%, something like that. I don't know the exact numbers, but I think that's kind of the point people would make, is that, okay, it's slowly already waning. We're already moving into this kind of multipolar world, that it's not just going to happen like this, but it's just going to be like a slow waning factor. What's your take on that? Do you agree or disagree, or how would you explain that?
Oh, yeah, no, I completely agree, right? I mean, who wants to own the long bond when the Fed's hiking rates and inflation is still high and you're losing money in real terms? Like, it makes no sense. I mean, TLT, the main, long-term bond ETF, is down 50% in 3 years. And so if you hold long-term bonds, you got screwed. And so imagine you're the Treasury Secretary of a third world country. You bought a bunch of US bonds, and now you're down 50% or 45% on those investments. You don't want to do that. You don't want to hold that. And the US dollar, everyone said and everyone knows long term, no single fiat currency can exist as the global reserve currency forever. You can't, because of what we talked about, Triffin's dilemma. Like the centrally issued fiat currency has to issue more and more currency to the rest of the world as it grows. And that means that it itself gets buried deeper and deeper in debt, and until it has a sovereign debt crisis. And once it has a sovereign debt crisis, it has to print its way out, and then inflation roars, and then that currency loses value, and no one wants to hold it as a reserve currency anymore. And so that can start in stages, right? So we can see that first happening with the long bonds, and China, for example, reducing its U.S. Treasury holdings of long bonds. And the Treasury, last October, had an announcement, and they reduced the pace of issuance of their 20 and 30-year bonds and increased their 2 and 5 and 7-year notes. And so, the Treasury itself is saying, like, we don't have enough, nobody wants to buy these long bonds anymore. We have to switch to more bill issuance and more short-term issuance. And a shocking stat is that in the first quarter of this year, 71% of the Treasury's funding was from T-bills, so 1 year duration or less. We're essentially slowly becoming a banana republic because nobody wants these long bonds. But eventually, what I've been saying is that, right, like, this problem will get so bad that people will start looking for a new global reserve currency. And I believe that Bitcoin is the front runner in that game because it's just a better version of gold.
Back to the show in a moment. CoinKite.com are my favorite providers of Bitcoin hardware security products. Now, when it comes to securing our Bitcoin, as we say, it's not your keys, not your coins, and you need to learn to use some of these different tools to help create your private keys offline and then keep your private keys offline. And that's where some of these devices like the Cold Card Mark IV or the new Cold Card Q device can come in and help you, because they can help you create your private keys offline. You write down your 12 or 24 word seed, and that helps you interact with the Bitcoin network in a self-sovereign way. And so you can use these devices easily with software such as Sparrow Wallet or Electrum or Spectre or Nunchuck as a few examples. Now, the really cool part is that you're keeping the private keys offline because you're signing in an offline way. So if you're a beginner, yes, you can just directly plug it to the computer, but you can use these devices also in an air-gapped mode. So for example, the micro SD card, which is available on the Mark IV, or you can also use micro SD cards on the Cold Card Q. And the Cold Card Q also has an extra way, which is this QR code. So you can scan and read it back that way and do your transactions also in that fashion. So there's a range of different features and ways that you can improve your security, but you can just start basic with a single signature hardware wallet, and then later think about, okay, do I want to do a passphrase? Do I want to use BIP85? Do I want to use Seed XOR? Do I want to use multi-signature? So these are all some of the things that are available to you. The Cold Card and CoinKite team are always innovating and putting out new products. They have a range of different products. So for example, the Tap Signer is a cheaper device for those people who want a specific different kind of UX. That's also there. They also have the Seed Plate, which is a way for you to back up your seed words in a metal product. So there's all kinds of products there. Go to coinkite.com to get yours and use the code Livera for a discount over at coinkite.com. This show also brought to you by Mempool.space, the leading Bitcoin and blockchain visualizer. I use it all the time to keep an eye on what's happening in Bitcoin's mempool, to keep an eye on the fee rates in order to get into the next Bitcoin block. Of course, you can search Bitcoin transactions and see all kinds of information. They have all kinds of ways to visualize important information, whether that is the RBF history of a particular transaction, the replaced by fee history, or looking at what's going on in the mempool in terms of transaction fee rates. Now, for those of you interested, they have a Mempool Enterprise program. If you're with a company and you want to support Mempool.space, they've got various options, including support for things like a co-branded Mempool.space or an improved SLA or with increased API limits. With the higher tiers, you can have increased access to the team for things like feature requests, as well as having more custom design opportunities available. So for those of you interested, go and check that out over at mempool.space/enterprise. And for those of you who just want to see the fee rates and search things, mempool.space is the site for you. And now, back to the show. Fantastic. And when people are buying government bonds, often it's under this mistaken belief that it's the risk-free rate. Or, this is what they teach us in university finance classes. The US 10-year bond is the risk-free rate, and you should hold it. And they propagandize everybody. Everyone's kind of been psyoped into believing that's the way. And I wonder how much work was put into making everyone believe that 60-40 stocks and bonds, 60% stocks and 40% bonds is kind of a good allocation, that every good little financial planner and advisor, you tell your customers, you tell your clients, this is the way. And, people would sort of craft these explanations. Oh, okay, look, the idea is that stocks and bonds, one should zig, the other should zag. So that way, if you have 60-40 stocks and bonds, if your stocks goes down, maybe your bonds will kind of either stay or go up. And that's why you'll be okay. How much of that is truth? How much of that is propaganda? Or was it maybe historically true, like for a time period, and now it's no longer true?
That's exactly right. So since the Volcker shock in 1981, it has been true, right? Because for 40 years, we've had declining real interest rates until this recent, hiking cycle. And we had a 40-year bull market in stocks. And so you could own both bonds and stocks, and they would both do well, and your portfolio would perform. And generally, bonds and stocks were inversely correlated, where when there was a crisis, they would, bonds would be bid because everyone goes to safety, and stocks would fall, like in 2008 or in 2020, for example. But now that's changing. Now there's a structural bid for equities because equities aren't indexed as hard to future, fixed cash flows, and there's been a loss of bond demand. And again, we can see that there's plenty of ways we can see that. We can see that with the 20 and 30-year bonds, with their price. We can see that with the Treasury itself, issuing more and more short-term bonds because they just can't sell enough of the long bonds to justify it. We also see, and I actually did a piece about this called Stealth QE, where I looked at the Fed's balance sheet and I broke it down by maturity and week-over-week changes. And something that shocked me is, we've been doing this taper for about almost 2 years now, right? And they actually haven't been selling any of their long bonds. They've been buying 20 and 30-year bonds, and they've been compensating by selling
keep going.
More. Yeah, they've been selling more of the, they're laying off all the short-term bills. And so basically, there's no, again, the bond market is dying a slow death. This is similar to what happened to the Bank of Japan, where the Fed just has to slowly eat, or the central bank has to slowly eat, first the long bonds, and then you move to shorter and shorter maturities as people's, desire for this debt falls off a cliff. And so, yeah, it's an interesting dynamic because, like I said, Japan is just at the forefront of this. And I think that this is coming for the Fed. I think this is coming for the ECB. I think this is coming for the BOE. The PBOC, the Bank of China, all of these central banks are going to eventually face this because their governments are all stuck in a debt interest doom loop, and the only way out really is QE and eating their domestic bond market.
Yeah, and so related to that, there's this concept known as financial repression, right? This idea that what they'll do is give you an interest rate that is lower than the real inflation rate, meaning you're kind of a bag holder, right? They want lots of bag holders, and they're just kind of debasing the bag holders. So if you're holding US treasuries or US dollar fiat cash and coins, you're just getting debased. And so I guess let's say the powers that be that want to try to sort of keep the system stable, they want you to believe that the US Treasury is such a great asset, we should all hold it, or you should hold it, plebs, hold this thing, and we can keep printing more of it and dump our bags onto you. And in this way, quote unquote, their reasoning is to sort of inflate away that debt, to kind of lower the real, purchasing power amount of that debt, to try to sort of eke it out and try to keep the party going. That's how I'm seeing it. What do you see? Do you agree or disagree, or how are you seeing it?
Oh, absolutely. I mean, for example, the CPI. I actually did a piece doing a little bit of research into the CPI and unemployment, which, by the way, unemployment is a complete sham. Their unemployment numbers are turning into hot garbage. I mean, the government stats have always been faulty, but just recently they've gone off a cliff. There were unemployment like Jim Bianco pointed this on Twitter. On March 31st, the previous 6 weeks of unemployment filings numbers were all 212,000 exactly. Or no, 5 out of the 6 were 212,000 exactly. And so he said, like, imagine this, like an economy of this size, how can we have the exact same number reported for 5 out of 6 weeks? Like, that's statistically impossible. It's like a Six Sigma event. Like, that just people not being able to log in their computer would throw it off by 1,000. And they round to the nearest 1,000. And so he's like, how are we getting the same unemployment filing numbers for 5 weeks in a row? It's just not possible. And with the CPI, they've changed the calculation 30 times in the last 20 years. There's a research paper actually done by, I think it's the National Bureau of Economic Research, NBER, and they document it. And you can see, like, here, okay, they changed the calculation of used car prices, and now if a used car gets cleaned and updated, and someone puts a new engine, we're gonna lower the value. We're gonna increase, quote unquote, the value of the car, which would lower the price, and so that will help the CPI. And we're gonna, there's a recession, so hey, we're gonna change the CPI. So if there's a recession, people aren't gonna buy bacon and eggs. We're just gonna change the weighting for breakfast items to cereal and milk. And so it's cheaper. And so then the inflation number doesn't go up as much. So I think realized inflation, they quoted the core PCE last month came out at 2.8%. I think realized is probably still around 5. That seems about right. At the peak, it was probably around 16 or 17, according to Shadow Stats. And they have interest rates right at 5%. And so if that's the case, then they're already doing financial repression right now. And when the next wave of inflation comes, they'll do the same. Because the Fed itself can't really raise rates much farther above where they are right now. We're at 5.25 on the Fed funds, and most of the yield curve is around there or in the high 4s. And if inflation rises, they're faced with this dilemma of, do we raise rates? And if they do, they run into the issue of the debt doom loop. Right. Last year, they paid more than $1 trillion in interest expense. This year, they're slated to pay $1.5 trillion. They added $1 trillion. They're going to add this year $1 trillion of debt every 100 days, according to Zero Hedge. They've already added 700, 800 billion as of mid-March, and so they're trapped. They can't raise rates. They have to keep them where they are, and they can also lower rates because that will just cause more inflation. They can't ease harder without more inflation. And so what their goal is to slowly drain you of your wealth over time if you're not holding the proper assets, right? They're just going to say, hey, inflation is going to be 7%. We'll hold them at 5. We'll hold them at 4. And you're just going to bleed out. And you know what? If we lower rates to 1, it'll get even worse because inflation will go to 6, 7, 8. And realize will probably be at 12, and we'll hold the rate at 1 or 0, and you'll just make no money. And we're going to debase this thing out from under you because we can't pay the debt in real terms.
So are the people going to just keep buying it? I guess that's the big question as well, right? Because what the everyday people do matters, right? Like if there's this kind of default flow into buying government bonds, and maybe equities, like that's a typical thing people are doing. Like they're just kind of stacking. Because obviously, everyday average people, they're not quite at the point like you and I where we're stacking sats and we're hodling on our, self-custody. The average person, if they are a saver, they might have a few buckets they put things into first. Any default excess would generally go into their stock portfolio, maybe bonds, and maybe they take a small amount and they're gambling on meme coins and shit coins or whatever other speculative things. But generally speaking, they're kind of flowing that money into the S&P 500 or something like that, and bonds. So how long until that starts to shift in your view, or do you have a view?
I do have a view. So, I know this isn't a macro podcast. Again, I've listened to a ton of your shows. I know it's mostly like very technical Bitcoin, like Lightning channels and payments and nodes and stuff. So again, this might be like come a little out of the wheelhouse, but what the process you're exactly talking about is already happening. On March 7th of this year, the ISDA, which is the International Securities and Derivatives Association, which is essentially all the large banks, sent a letter to the Fed and the OCC and the CFTC, asking them for what is called a permanent SLR exemption. And the SLR is the supplementary leverage ratio. So that's basically like the amount of capital they have to hold against an asset in case the asset loses value. And so if, for treasury bonds, it might be 10%. For mortgage-backed securities, it might be 15%. And then for something riskier like an equity, it might be 30%, right? Just in case it loses value, they have capital set aside to make sure the bank's not insolvent. And back in March 2020, the Fed had exempted all the banks from the SLR because what happened is, they said, look, there's a giant fire sale of U.S. Treasury bonds happening in the market. The market became disorderly. The Fed began obviously ramping up QE, buying bonds, and then they also bought corporate bond ETFs for the first time in history, which isn't well reported. But even with that, they knew that the coming wave of debt issuance from the U.S. government was just going to be so huge. They're like, we can't absorb all this ourselves. We're going to exempt the banks from the SLR. We're going to exempt Treasury bonds from the SLR, which means you have to hold zero capital against your bonds that you buy. So that means you can basically buy the bonds. You don't have to hold any money against them. Whatever happens with them, you don't really care, unless, of course, the rest of your portfolio is going underwater. And you just hold them to maturity, which is the goal of every bank, right? And so they exempted them for a year. And so during the COVID debt bonanza, they let all these banks swallow up a shit ton of treasury debt. And then they ended the exemption. And now, another year and a half, 2 years later, the banks are coming back and asking for it without a traditional financial crisis, without COVID, without a economy-wide shutdown. And the reason why they're asking for it is because the dealers can't find enough demand, in the market. That they're taking this treasury debt, which they're getting loaded with because the treasury is just starting to, vomit out debt as faster than they can even purchase it, and then they're turning around and there's not enough buyers. Retail is tapped out. We're almost out of. We've almost run out of all the pandemic savings. Reverse repo is being drawn down, which is it's a window that allows people to post cash to the Fed, or post treasury bonds to the Fed and then get cash and get interest rates on it, right? So there's just not that cash is being drained and being used by treasury bonds, and so there's not enough demand now. And so the banks themselves are saying, hey, look, like if you want to maintain an orderly treasury market, you need to exempt us and allow us to buy bonds with essentially an infinite leverage, right? With 0% capital reserves, because that's the only way this is going to work. And what the banks want, the banks usually get. And so what's likely going to happen is the Fed is going to have to approve of this. And within a month or two, they're going to have to the banks themselves are going to start swallowing more and more of the treasury debt. And again, this means that basically you hold your money in a bank, your bank is increasingly becoming an appendage of the U.S. Treasury. It's just going to, the Fed is essentially saying, hey, look, like we can't take all this issuance, all the commercial banks, all the investment banks, you guys just swallow this stuff, let your depositors be on the hook for it. And if you fail, we'll bail you out and use printed money to do that. So it's just a roundabout way of doing more QE.
Yeah, wow, that's interesting because it's like there's different ways to think about that. You can see it as kind of a quasi nationalization or kind of a quasi forced hodl, right? They're kind of forcing everyday banks to hodl the US government debt bags, and so these are some of the different ways in which we could analyze that. And so I guess one other question people might have is, they might have heard that, hey, there's central banks around the world that are buying lots of gold. What do you make of that?
Well, this is exactly the trend I've been talking about, right? Like these governments are saying, hey, we don't want to own U.S. debt. Like the U.S. is in a trap, just like Japan. They're in a debt trap, and so they can't get out without printing money. And the long bonds especially are going to get killed. And so we need to sell this and get something that's going to hold value better. And central banks are obviously, very captured institutions. They're the epitome of one. And so they can't, they don't have the, foresight to turn to Bitcoin. And so they're buying the next best thing, which is gold, right? So they're saying, hey, look, we're preparing for a switch of reserve currencies eventually. We want to hold something that's a neutral reserve asset that has no counterparty risk, that we can hold on our own books and not worry about, it losing 50% of its value just because the Fed has to hike. So that's that trend of, de-dollarization. And it happens slowly. It happens over time. But the first way it starts is the U.S. Treasury itself our long bonds and then our short bonds are losing global reserve status. And this is really bearish for the U.S. as well. Again, like most people don't realize how bad this is because the foreign sector has been one of the largest buyers of Treasury debt, right? They bought $7.5 trillion over the past 20 years of U.S. Treasury bonds. In 2008, China itself, in about a year and a half time frame, they bought 71%. Or no, foreigners, sorry, not all, just China. China bought like 40%, but all foreigners bought 71% of all Treasury debt issued from 2008 to 2010. So they funded our deficit spending. And now they're saying, no, we don't want to do that. And, what I posit to you and what I've said to Marty as well, like, what happens if these foreign finance ministers actually start to grow a couple brain cells and say, hey, like, instead of having our central bank issue currency and buy bonds with it and it's just going to go down, why don't we just use Bitcoin as a reserve asset? Why don't we put it on our balance sheet? Why don't we start trading with other countries in Bitcoin and settling in Bitcoin? And then we don't have to worry about this issue of, the debt doom loop in the US. And that could be, that would change everything for Bitcoin, I think. Nation state level, geopolitical acquisition of large chunks of Bitcoin.
Yeah. And so there's a lot of talk about things like quantitative easing, right? And that was, from the kind of the years post 2008, there was a lot of QE, but there's also this concept of qualitative easing, right? There's this concept that whether you as a bank or as a central bank can start selling out your good assets and buying worse assets. And you can think of it like when those banks were forced to hold, or when the central banks were forced to hold these, the toxic assets, that was like a qualitative easing in a way. So I guess you're sort of pointing it out in that way that they're thinking more clearly about the quality of the assets that they hold. And in that way, each of these central banks is out there trying, right? Failing, not except unless they're buying Bitcoin without saying it. They're trying to find some other higher quality thing to hold. Now, of course, you and I and listeners of this show all know kind of the end answer, which is Bitcoin is the highest quality thing to hold. And so it's kind of just interesting to see that. And what we've also seen is just that every time some kind of crisis happens, there's a new program, right? It's QE1, QE2, QE3. The recent, 2023, there was the whole BTFP. There's always some new program. They find some new way to sort of kick the can to try to play this financial repression game and sort of keep the party rolling. And so I guess that's kind of where it's at. So if you have any ideas on kind of what programs or what ideas, or would you say it's mainly just that bank one, the in terms of the SLR aspect? Do you would say that's kind of the main program that they're applying now?
That's a big one, right? And again, like I've said this before, like a lot of people said, well, why now? Like why do they need to request an SLR exemption? Why do they need more leverage? Why do they need to get rid of all reserves against holding treasuries? And I say, look, there is a crisis and it's the debt. And that's a big enough crisis now that it's actually forcing them to change this. And so the SLR is a huge part of it. But like I said, there's other ways that they can ease stealthily without easing on paper, right? So, I mean, for one, we just had an FOMC meeting this week, and Powell slowed the pace of the taper in Treasury securities from $60 billion a month to $25 billion a month. And agency securities, I believe, is at $20 billion a month as well. And so they half the pace of the taper. And on the other hand, they also, like I said, they're not selling any long bonds. They're actually buying the long bonds, and they're only selling T-bills. And the Treasury itself is switching their issuance all to short-term issuance. And they're also participating for the first time in 20 years in Treasury buybacks. So they're buying back their own bonds with excess money in the TGA because there's certain issuances that are just so liquid that nobody wants to own. And so we're running into this issue where, they're having to come up with newer novel ways to add liquidity to the system secretly without adding liquidity. And the reason why, like, for example, with the long bonds, the reason why that's net additive to this, like in terms of liquidity to the system, is because banks are required to hold, like, again, under the current regulatory framework, right? Like, they're required to hold reserves against a bond. And the longer the duration of the bond, the more sensitive it is to interest rates. And so that means it has to hold more capital against that bond in case the bond loses value. And so if they hold long bonds, then they have to hold a ton of capital away, stored away on the balance sheet as reserves in case the long bonds go down. And the long bonds are very sensitive, so they can go down a lot. And so by switching the issuance to short term, and by the Fed itself taking the long bonds off the balance sheet, the Treasury issuing fewer long bonds, that allows more liquidity to flood back into the system and keep the stock market and the illusion of growth going. And so that's what they're doing now. But I'm sure, I mean, exactly what you said. Like, it's funny. All the Fed watchers tell you the same thing, right? They're just like, hey, the Fed's mandate is they have a dual mandate, man. Like, they have unemployment, they have inflation. That's what they're worried about. No, they're worried about systemic stability more than anything. They don't give they could give a rat's ass about inflation as long as they can hold their credibility in line and as long as they can keep the financial system running. And so whenever there's a crisis, they're just going to find new and novel ways to create money and to put into the system without calling it, printing money. So I think with the next crisis, I mean, we'll wait to see what they do exactly. I don't know what it'll be. But like I said, we already have several things they're doing. The Treasury buyback program, the SLR, the Fed quasi-taper that's kind of not really a taper, and I'm sure they'll come up with more.
Back to the show in a moment. Swan.com is the leading place to buy Bitcoin, and the Swan team has a mission to onboard millions of people into Bitcoin. Now, the team have been working really hard to update the Swan Bitcoin app, which you can find on the Apple App Store or the Google Play Store. So the team have created a really slick and smooth experience. So now you can go from zero to Bitcoin in just a few minutes. So if you have family and friends who you are struggling to get them onboarded, well, Swan Bitcoin application is a great way for you to help them. You can be staying there right there with them, and in just a few minutes, they can have been onboarded and be buying Bitcoin. And Swan are making it really easy to do this because now there's zero fees on the first $10,000 of Bitcoin buys that you do. And it's not just for new customers, it's also for existing customers. So remember to tell your friends and family to go to the App Store and search Swan Bitcoin, install the app, and get started with Bitcoin with Swan Bitcoin. And now back to the show. Fascinating. And so, yeah, it just kind of all, but at the end of the day, none of us really knows the timing, right? And there are people who are saying, well, are we going to have a recession this year, or etc. And people are kind of going back and forth on that idea as well, because they were talking about this, the yield curve inversion, and that being a predictor of recession. But at the same time, as you were kind of pointing out earlier, there's different ways that they try to mask that, right? And so Biden and his administration is out here saying, oh, look, it's such a great economy, and you guys just don't see how good it is. And then actually you look at you see all these stories of people who are struggling and they can't make ends meet, and it feels like they're so much worse off than they were in 2019 or something like this. So yeah, do you have any view on the whole recession question?
Yeah, that's a good point. So I believe, okay, first of all, I'll caveat this with this first opening statement. I wrote this in one of my most, one of my most viral pieces was called Financial Gravity, where I talked about, what the Fed did post 2008, how it hurt the real economy, how they propped up the financial economy and just made asset prices go up because they were doing QE. If you use the original 1970 definition, the NBERS definition, National Bureau of Economic Research, technically after 2008, we were in depression because we were underperforming GDP potential for more than 2 years, for more than 8 quarters. And so we were technically in a depression, but the Fed didn't call it depression. They changed the definition to just call it a recession or a great recession, right? And post 2020, it's kind of been a replay of the same thing where the underlying stats of the real economy are not looking good, but the Fed is able to the Fed and the BLS and the other government agencies that report statistics are able to paper it over by creating a rising stock market and then kind of fudging all the jobs numbers to make things look better than they actually are. I mean, for example, on that recent piece I did diving into the jobs numbers, not only was there that weird anomaly where there's 5 weeks in a row of the exact same payroll number that usually fluctuates by 20,000 or 30,000, or not payroll, sorry, unemployment filings, that usually fluctuates by 20 or 30K, and it's the exact same number for 5 weeks in a row. But their employment statistics are severely broken. So they can change what they consider to be unemployed and what they consider to be in the labor force. And so if you haven't looked for work in more than 12 months, they can take you out of the labor force bucket. And
Right,
that
because
means
you're not
that
seeking
overall,
employment. Yeah.
you're not seeking unemployment or seeking employment. And so the bucket shrinks. And so even though there might be, a change in the actual number of unemployed, the rate can go down because the entire bucket is shrinking, right? You're going from, like, let's say 100 million people in the labor force to 95. And there's a guy named Daniel Ahneman or something like this, who did a research piece on this in 2012 and showed, like, he's like, look, the government removed in 6 months 1.1 million people from the workforce. And because of that, the employment numbers look decent. It looks like unemployment's been falling, but in reality, it's not. And if you use the U6 or even the broadest definition of unemployment, which just takes the whole, basically everybody except for people who are severely disabled or, hospitalized, post-Great Recession, we were north of 15% unemployment. We were ranging between 15 and 19%. And I think that that's more accurate. Like, a lot of young people I know don't have jobs or find it difficult to find a full-time job. And in the past 2 years, the only reason the employment number has even been anything sort of, anything remotely good is because part-time workers have been increasing. So we've had a drop of, several 100,000 in full-time up to 1 million. We don't really know because the BLS numbers are so bad. I mean, again, like last November, the New York Post put out a piece saying, hey, the BLS overestimated jobs numbers by 490,000 during this year, which is like half of the growth, quote unquote, growth that we saw. And even the New York Fed, it's the Philly Fed, they have an algorithm, and their algorithm, crunched the jobs numbers and said, hey, you overcounted in 2023, you overcounted it by 1.1 million people. There's 1.1 million people less employed than you said, based on the statistics you showed me. It doesn't make sense. And so I think that their numbers are kind of scammy. And I think if you look at the real economy, you see this all over the place. The amount of homeless are rising, drug addicts, depression, anxiety, all these mental health disorders are increasing. And just anecdotally, I know people that just, you cannot find a full-time job. Everyone just can get part-time work. I can get a part-time finance, analyst job, or I can do a part-time contracting for software. Like, they're laying off a bunch of full-time people and just moving to part-time. And so, yeah, I think we're in a recession. If we're not in a recession right now, we're probably slowly entering one. The last GDP print for Q1 was 1.6%, which was 50% miss to the downside. And that was with the government adding jobs, right? Like, I mean, there's a stat, like, this is crazy, but like last September, we had a jobs payroll number of something like 230K, and over half of that was government jobs or connected to government spending. And so it's like, are we really seeing growth, or is it just the government deficit spending is exploding and that's creating jobs growth because the government's hiring people to do their programs, and that's what's, quote unquote, propping up the economy? But again, we know this from Austrian economics. This can't last forever, right? With the private sector needs to grow, and they're stuck in a conundrum. They're stuck in a rock and a hard place. There's not really any way out other than them just letting this thing slowly deflate and letting the currency slowly die.
Yeah, sad to see. As you said, the government can, quote unquote, prop up the numbers, and people were, I guess, recently pointing out, oh, look, see, the US government, US GDP recently rose above European GDP. And it's sort of like, yeah, but I wonder what these numbers would look like if you factored out the government spending. Now, to be clear, I'm sure the EU has a ton of government spending too, but it's kind of, people talk about GDP like it represents some real thing, but there are actually a lot of Austrian critiques of the GDP number because it can get manipulated in certain ways, and it only counts final outputs and not intermediary goods also. So that's like another angle of critique. But I guess, I mean, it all comes back to Bitcoin. So I'm curious if you have any thoughts on where things are going Bitcoin-wise.
Yeah, sure. No, I've been, massively bullish Bitcoin, like I said, since I started, reading and actually understanding it. I was unfortunately fudded out of Bitcoin in 2018 after reading a book that was saying that the transaction speed's so low, so it can't work as global money. But once I read Nick Bhatia's book and Layered Money, I was like, wow, this makes a lot of sense. Like, the economy, the financial economy exists in layers. The base layer doesn't need to handle Visa level transactions. It just needs to handle basically global global reserve currency level transactions, or FedWire, which coincidentally is actually just about, the throughput of Bitcoin, 5 to 6 to 7 transactions a second. And so Bitcoin can exist as the global reserve asset, or the large transaction money, and then we can use Lightning and other protocols as the second layer for microtransactions. And I wrote a piece, Bitcoin solves Triffin's dilemma, and so I was kind of postulating what I talked to you about earlier, like what happens when these large, nation state level actors, and we're talking like Russia, China, Japan, start deciding, hey, like our U.S. foreign currency reserves are falling, our U.S. Treasury bonds are falling, we're having our own problem with inflation. What if we acquired Bitcoin on our balance sheet? What if we use that to settle international trade instead of using, dollars? And that would completely change everything, because it would speed up the death of the dollar itself. But it would also accelerate Bitcoin adoption massively. And we may not like nation state actors to, getting their hands on sats. But if they do, it would create a flywheel effect, forcing more and more countries to come into the Bitcoin fold and to start buying Bitcoin, and then to encourage their citizens to use Bitcoin. And likely, if they did that, they would have to make Bitcoin legal tender, because they'd want to have, as a nation state, they want to have earnings in Bitcoin so that they could fill up their treasury and use that to settle trade. And so, or to use as, currency reserves. And so that would speed up the death of basically every single fiat currency, but obviously, foremost the US dollar. And the Bitcoin price in that case could be huge, right? We're talking, there's $400 trillion of global debt. There's around $100 trillion globally of central bank assets and global FX reserves. So if all that money flows into Bitcoin, who knows where the price will go. But again, this is a long-term thing. For the short term, this cycle, I would say it's been massively bullish, right? We're already above. We beat all-time highs before the halving, and that's huge. And right after the halving is actually usually, I was looking at some charts yesterday, like the pool multiple usually falls right after the halving. We usually see a pullback. So these next few weeks, I don't expect that the price will move, anywhere higher than where it's at right now. But I think, again, like long term, as these institutional flows start moving into Bitcoin, and furthermore, as the Fed is reaching the end of their hiking cycle, and as we begin to cut and liquidity really comes back in earnest, Bitcoin's going to rip to the moon. Like this thing is gonna really go. And so I've been stacking as hard as I can, and I've been encouraging all my family members to do the same, because I think Bitcoin solves so many of these problems globally, right? Like it's unfair that a single country can issue a reserve currency and profit from the work and labor of other countries. And that's what the U.S. has been doing for the last 30 years. We've been issuing U.S. Treasury debt. We've been issuing dollars, printing dollars, and those dollars go to buy goods that people work for. And then once those people work for those goods, they get those dollars, they recycle them into U.S. Treasuries, which further strengthens U.S. dollar hegemony. And so the U.S. has been the bully of the system for the last 30, 40 years. And it hasn't worked out well for anyone, and least of all us, right? Like we've offshored our manufacturing base. We've created I would say like a mental health epidemic, especially in the Midwest, where all the manufacturing jobs have left. And that doesn't need to be the case. Under a Bitcoin standard, every country will just compete purely based on their productivity and innovation levels. You don't need to worry about currency flows. No country will devalue itself to make itself more competitive and drive jobs to itself at the expense of other countries. And so globally, Bitcoin solves it's that meme, like Bitcoin solves this, but truly, like on the macro side, globally, Bitcoin solves almost every dilemma. It solves Triffin's dilemma. It solves the impossible Trinity. It solves the import-export, issues, current account deficits and surpluses, and, loss of jobs from bigger than neighbor policies of just devaluing your currency. It solves all of them. And so I'm really bullish for the future. I'm excited for what's happening and for, the coming adoption. And I'm hopeful that, all these fiat problems that we're dealing with can finally be fixed and we can move on to a better world.
Well, I think that's fantastic. I think, as you said, it may be, let's say, given Bitcoin's current size of, let's say, or 1.2 trillion, in that range. It may be small for some of the larger governments to really be interested, at least for now. But that said, I mean, there are governments who already hold Bitcoin. In some cases, it's because of seizure, like the US government, seizing like Silk Road coins or other things like this. North Korea is rumored to have some. El Salvador is openly stacking Bitcoin. But I think maybe for this cycle, it's more about, ETFs and just everyday people buying, right? Whether that's at Swan or wherever else, like people just buying, Bitcoin. And so I think it'll just be a time thing. But I think in some ways people can be really doomer and like, oh no, it's all over. But on the other hand, you can sort of stack sats and look forward to something positive. So I think that's probably a great spot to finish up. Just before we finish up, where can people find you online? And we'll put them in the show notes.
Sure, yeah. So I have a Twitter, which is at Peruvian_Bull. I have a Substack, which is $endgame.substack.com. That's where I cover all the macro stuff. So I talk about what's happening in Japan. I talk about what's happening in China and the US and our debt crisis. I've had, like I said, some pieces on Bitcoin if you're interested in reading those. And I also have a Nostr. I've tweeted the link a couple times, but I'll probably just pin it in my bio on Twitter, and so you can find that. And the Nostr is also linked on my Substack. And then I also have a YouTube. So I've been creating slowly but surely YouTube video versions of some of my pieces so that people can just like watch it instead of having to read a long, 20-page like essay on financial gravity and the Fed's dilemma. So that's the best place to find me. And thanks again for inviting me on. It's been a blast.
Fantastic. Well, thanks for joining me. I hope you enjoyed the chat. Make sure to share this episode and press like and give us a thumbs up if you enjoyed this episode. Thanks, and I'll see you in the Citadels.